So, hi everybody, this is Also Hub. I'm Giacomo, and today I'm going to analyze Caterpillar. This is one of the stocks that you asked me to analyze. So, before we get into the video of today, a few disclaimers. First is this is not financial advice, and the data that I've taken comes from Seeking Alpha and the New York University website, the part managed by Aswat Damodaran. So, let's start by making some of the assumptions that we need to make this analysis, this discounted cash flow analysis. First, we start off with the risk-free rate. That is, I've taken the interest rate swap for the next 10 years as of now, and it is around 4%. So I've taken that as a reference. Next, we have the risk premium. I've taken it from the spreadsheet from Aswath Damodaran that he publishes, I think, every year. And this year, the risk premium for the United States, he said, was 4.6%. So yeah, here it is. Then we have the beta. For the last 24 months, it has been 1.21%. And so I've used it as a reference for Caterpillar. Next, we try to estimate the cost of debt. Over here, I kept it quite high because Caterpillar has a pretty high debt to capital ratio. That is not necessarily a bad thing because it can be used to decrease the cost of capital, but it can drag your results in case of a unexpected downturn. And Caterpillar is pretty cyclical, given that it depends on how construction goes around the world, mainly in the United States. So when the downturn comes, Caterpillar has a hard time selling its equipment. There's less demand for its equipment, so it sells less. And yeah, but at the time of this recording, we're probably going to see the Fed cut some interest rates later this year. So probably construction, usually when rates go down, constructions tend to increase, especially in the United States. That market is more responsive than others. So yeah, these are the assumptions that I've made for the weighted average cost of capital. And then we have some highlights for the last 10 years. We can see that the revenue has gone up, but not that much. It had a bit of a hard time around the times of COVID and so on. And then it went back up, and it's continuing to grow. Then we have the earnings. They have done pretty well on the earnings. They have increased probably the margin very much. And here we see the free cash flow growth. And yeah, they were able to grow at a pretty sustainable and steady pace, the free cash flow as well. So over here, we try to make assumptions for what we can expect for the future. For the short run, I've kept it pretty much at the same pace of what it has done in the past 10 years. So I've kept it around 7.5, and so on. And then from the fourth year onwards, it grows at 5%. This is my assumption, and for the long term, I've kept it at what I think is the sustainable growth for Caterpillar. They usually take as a reference the GDP. So Caterpillar is exposed globally, but mainly in the US, and the US is expected to grow for the long run on average around 3% every year. Probably this year is going to be around 2.5 and so on, but you have to take into consideration that interest rates are still high, and despite that, the US is doing well, so it could probably do even better with lower rates. So yeah, these are the explanation, the explanation behind these assumptions over here. So next, we calculate the terminal value. Here we have the calculation. It's based on the last year free cash flow, and then you have this calculation to calculate the value of the free cash flows in perpetual growth at this rate over here, 3%. And yeah, so then we have the present value of that terminal value, and we add that to the sum of the free cash flows at the present value. So here they are. Next, we have the debt. This is a net positive position because no, actually is a negative position because Caterpillar has some debt, and then we subtract the other things that could dilute our position, such as options given to the management, to the employees, and so on. It has, last time I checked, 5.1 million outstanding options that could be exercised. The exercise price is 169, the weighted average one. So that means that they're most likely to be exercised, all of them. I didn't use the Black-Scholes model for just simplifying the whole process. It's probably, the fair value of that is probably a little bit higher than that, but not at the same value that you would have if you would estimate that the options would be exercised only at the expiration time, because they usually get exercised way before that, because time usually increases the value of the option if you have studied derivatives. But yeah, probably it's slightly higher than that. Then we have the restricted and performance stock units. I simply multiply the ones outstanding by the value, the current share price, that is around 350, and then we come up with the value of equity, and we divide it by the outstanding shares, and we come up with a value of 369 compared to the 350. But we have to say that this is not a big enough margin to say that this is a value play, because these are just assumptions. Things can change very much if we change it just by a little bit. Here's what happens if we say that it grows a little bit less and the cost of capital is slightly higher than what we expect. So yeah, this is what would happen. I don't think it's fair to say that the cost of capital would go up in the medium term, because it's pretty much expected to go down. But yeah, you have to take that into consideration, and I think that given the latest results, unless we see a big result in the next few quarters, there's not that much room left for value as of now. Yes, the growth in the GDP, the growth in construction as a result of the interest rate slowdown of the cut that the Fed could possibly make. Plus, I think that in case of a Trump presidency, I don't have personal political interest. I don't live in the United States, but Trump has played the card of trying to build more in the US, trying to build more, have more factories in the US, and so on. So in that case, probably Caterpillar would benefit even more. But yeah, we have to see. As of now, given the assumptions that we have made, we don't have a big enough margin of safety. So yeah, you have to take that into consideration, because you probably can find some better deals as of now. But Caterpillar is a great company, great technology, great products, and so on. So I would never bet against a company like this. So probably I'll wait and watch Caterpillar, what it does in the next few days, in the coming months, and so on. And if opportunities comes by, maybe I'll think about buying something. But as of now, I don't think it's cheap enough for me to buy. So this is it for today. Make sure to like, subscribe, and comment with the next stocks you would want me to analyze, and I'll do them. So this is it for today. I'm Giacomo. This is Also Hub. See you next time.